Hello and good morning, everybody, and welcome to this month's edition of the Pulse Advisor webinar. Delighted to say we're being joined today by our friends at Canaccord, and we have Scott Goodrum with us today, who'll be running through the main session of the webinar. At the moment, you obviously have noticed all of the headlines going on around the world with wars and what have you. Markets are really just about headlines. So today, Scott will be looking through some more fundamental analysis around volatility, inflation, and interest rates. And in this session, we're going to explore what is driving that current market volatility, where inflation expectations are heading, and the outlook going forwards. And towards the end of the session, Scott will also introduce the IMPS Lite, which is a new solution available on the Novia Global platform. As ever, we will be recording the session today, and you will get copies of the slides afterwards. And if you have any questions, we have time at the end to cover off any questions and answers. And if you'd like to post using the chat function at the bottom of your screen, I'll collate those and bring them together, and we'll discuss those with Scott afterwards. So without any further ado, I'll hand you over to Scott. Thank you.
Thanks very much, Paul. I'll just share my screen and we'll get cracking. Just bear with me. So, Paul, would you just let me know if you can see me there, just looking through?
All good, thanks.
Brilliant. Well, thanks for allowing me to talk about markets today. Clearly, there's an immense amount of things going on in the world at the moment. So, the title of Volatility, Inflation, Interest Rate Uncertainty is apt. So there's certainly a lot to talk through. Of course, yesterday we had the US extending the ceasefire now indefinitely with Iran just before its expiration. The US is maintaining its naval blockade of the Strait at the moment still, though, and it remains unclear whether the US and Iran are going to have any further talks in Pakistan. I mean, the flight from America is 14 hours, so, they kind of need to get on with this and hopefully get over there soon. And we also had this morning Iran shooting at two ships in the Strait. But the strange thing, I suppose, for anyone following markets really is that they've really sort of shrugged off a lot of this. Markets are all, almost all markets really, certainly equities are back at all-time highs. And if you'd sort of looked at the end of Feb and looked in April, you'd have sort of thought nothing had happened. But clearly there's been a huge amount of volatility in March, and we're going to touch upon a little bit of that now. Before we delve any further into it, I just wanted to frame the current state of markets, our kind of expectations, if you will, for 2026. So we do still think that there'll be positive returns from bonds and equities this year, but volatility is clearly going to be much higher than we've been used to. And, that said, even the last 3 or 4 years, clearly there's been a lot of volatility as well, but this year could be even higher. We think the economic growth is likely to stay positive in the 3 to 3.5% range. We're not back up at the 4s and 5s, but it's reasonable growth globally, and that's kind of broad based where that's driven from. We think that there's a global recession is unlikely, although clearly this Middle East conflict could derail that. And some countries have been impacted far more than others, which we've also seen in terms of some of the equity movements, between different regions. Rate cuts or rate increases, rate cuts certainly we think are still on the table this year, but we need to keep an open mind, and we'll delve into a little bit more of that as we go through. So I guess just to frame 2026 from a geographic equity perspective, the last sort of year or so is on the left-hand side. What did well in 2025, so areas like the UK, emerging markets, Japan and Asia, very much continued that trend as we started 2026. And that was up to really the 1st of March when the conflict unfolded. And just to pick out two areas that did well, the UK, what was the reasoning for strong UK equity performance over the last year? And actually the UK has done quite well over the last few years. There's heavy exposure to global commodities, energy, defence stocks. The UK is still on a relatively low valuation. decent dividend yield, and actually some of the M&A we've seen has pushed up some share prices. And Japan is another area that did well in 2025 and continued that trend early in 2026. There's been a lot of corporate governance reforms in Japan, which has led to buybacks, higher dividends, basically people thinking more about the actual shareholders, really. The weaker yen has boosted exports, and there's also been a re-emergence of wage inflation, which has led to greater spending in Japan and greater demand. There's been some flipping, though, since the beginning of March. At that point, when the war started to unfold, the US actually began to, relatively speaking, outperform most of the other markets. Although in aggregate, for the whole year so far, it's not necessarily ahead of those other regions, but it's rallied much harder since March. And why has the US done well? There was a flight to the perceived safety of US equities. There was a flight to the US dollar as a safe haven currency. The US is also a net oil exporter, so it's much more insulated than other developed markets from swings in the oil price. It's also a market that's full of those mega cap familiar defensive growth stocks, your Mag 7s, etc. But also earnings in the US continue to actually be really strong and a support. And I think even if there is some hopefully lasting ceasefire slash deal that they come to, I think the moves that we've seen are unlikely to reverse, because I think there's going to be a bit more of a risk premium ongoing, which perhaps will provide support to US markets or other regions. And just moving on to delve into different equity sectors, what did well and what didn't. There's been a bit of a rotation really over the last 6 months or so from some of the tech names that did really well to more defensive sectors. You can see on the left-hand side graph, the global equity performance is in green, albeit this graph is a couple of weeks out of date to the end of March, and some of those endpoints are a little bit higher than they're showing on that graph. So what has been the winners? Firstly, utilities have done really well. You can see that in the light blue line at the top. So utilities have benefited massively from the huge increase in electricity demand from AI data centers, but also they've got defensive cash flow profiles, which in this uncertain world has been very well bid, so to speak. The yellow line is consumer staples, so your everyday items that you buy from the shop. Those types of strong brands have a good bit of pricing power, so that helps offset some of the cost increases that they've seen with the rises in energy and other things. The best sector clearly over the last month or two is energy. It's not on the graph, but that's been far the best performer for obvious reasons. Moving on to some of the losers, if you will. Technology, which is technology is the white line, but some of the communications sectors sort of similar-ish in terms of the reasons for that underperformance. It's really been the majority of the move has been the software companies, and their business models have essentially been challenged by some of these AI developments. Perhaps why a business is paying for software when maybe they can design them in-house. But also some of the hyperscalers that we've seen, massive, heavy AI capex. The market is evaluating how quick companies can see a return on that investment. Another sector which hasn't done great recently is financials in the purple line, and that's really around. Well, it's a sector that actually done really well before that, so potentially a bit of profit taking. But I think reduced credit demand due to high yields and inflation potentially, and worries about the economy generally. And then the last sector I wanted to touch upon, which also isn't on the chart, unfortunately, is consumer discretionary. And ultimately, as stubborn inflation hangs around, there's worries about the global economy. Are you really going to go out and buy that expensive watch, handbag, other type of good? I think probably not at the moment. So that's seen some weakness. Just looking at the US specifically, I mean, in our portfolios, we still allocate a little over half our equity exposure to the US. So, why is that? Just to frame some of those reasons. That the left-hand chart, which is just showing some of the valuations, that would show there at the top the US and USX Mag 7 are the two top lines. So they are absolutely more expensive on a range of valuation metrics than other regions, but we think this is absolutely justified, really. And on the right-hand side, you can see the return in the white of equity markets. As I said, in the last couple of weeks, actually, that white line shot up. Clearly, we're back at all-time highs. But what you see in the different colours that are superimposed, those are different quarterly earnings expectations. And, ultimately, as earnings have been revised higher and higher, the market has continued to chug on upwards. And that's essentially justifying those valuation multiples versus other regions. One nice thing that we've seen recently as well is some of the earnings growth. It's not just confined to the Mag 7 stocks. We've seen it broadening out into other areas of the market. Some of the other reasons why we still like the US as a region. The US definitely, started to recover quite strongly before the Iran war started to unfold. The Trump administration is still clearly focused on growth, almost at the expense of everything else. They maintain pretty loose fiscal policy. There's lots of tax refunds that are coming in 2026, which is no doubt positive for US economic growth. There's also kind of an underreported resurgence in some of the productivity growth in the US. So people are making more for less effort, if you will. And just finally, it goes without saying that the US remains at the epicenter of all things AI, both producing and also consuming. So I suppose that's a bit of the context of market equity moves. What might be useful for me to talk through a couple of the areas that we're looking at in portfolios here, some of the themes and why we like them. I just want to highlight three. Firstly, infrastructure, which we added about a year and a half ago to our portfolios. And why is that? Well, clearly the AI story requires absolutely immense amount of power and potentially almost exponentially more power. And that is really creating a bit of a super cycle in infrastructure. And also not just powering these data centers, but building them as well. Some of these infrastructure players are building these data centers as well that we've got. There's a lot of government spending on infrastructure, both in the UK, quite a bit in Europe, and definitely a lot in the US. So that's a nice tailwind. There's also an angle around energy security, so be it, building strategic storage, oil storage for the next conflict that might occur, but also increasing the use of renewable energy. Infrastructure as a sector as well is still on a very low valuation multiple. And a lot of the cash flows from infrastructure are linked to inflation. So as that's sort of crept up, that means that the cash flows are also increasing for some of these infrastructure companies. The second area I just wanted to touch upon would be emerging markets, which again we began allocating to sort of at the early part of 2025, which has done really well in portfolios. Why is that doing well? There's a variety of reasons really, but the weaker US dollar generally that we saw now versus say 2023 or 4 reduces the US debt funding costs for a lot of these emerging markets. They've got a lot of debt issued in dollars, so it's a bit cheaper for them to service that. Emerging market growth is expected to match or probably exceed developed markets in 2026, so that's a real positive. It's also a region with cheap valuations still, as other areas. Relatively stable inflation dynamics, which wouldn't have been the case 5 or 10 years ago. Most EM central banks are actually cutting rates rather than increasing them, other than a handful in places like Turkey and Russia. And fiscal deficits are actually much better in emerging markets than developed markets. Finally, emerging markets are now actually integral to the AI story. You think like hardware, like TSMC, for instance. EM's no longer just a cyclical mining energy player than it once was. And just finally, just a third theme that we're definitely looking at in portfolios and added to is quality as an equity factor. Quality, I mean, I suppose how do we sort of define what those are? Companies with good return on capital, low leverage, consistent cash flows, and those types of stocks or exposures offer downside protection. Historically, they would fall far less during market drawdowns, but tend to keep pace pretty much in moderate up markets, which we've sort of seen. And clearly, balance sheet strength is no longer just taken for granted with all the things that are going on in the world. And just moving on to the final asset class, which is alternatives. I mean, there's been a hell of a lot going on in the alternatives world over the last year or so. Last 6 months' performance of different areas of alternatives on the left-hand side graph. Hedge funds, which are the green line, essentially flat over the last 6 months. Industrial metals, things like copper and other metals, have done quite well, reasonably positive return over the last 6 months. In Q4 2025, precious metals were clearly the standout performer. You've got silver in the silver line and gold in the gold line. Just to characterize why they rallied so hard in Q4, we'll all have read stories in the newspapers and elsewhere. It was driven by record central bank demand, elevated geopolitical risk. There was some fiscal credibility concerns around higher debt levels in the developed markets, particularly, and also the slightly weaker dollar. And with gold being priced in dollars, if the dollar weakens, gold tends to tick up a bit. So what changed in Q1 2026 this year? Oil clearly has been the standout performer. You can see that on the purple line on the left. And sort of somewhat fortunately, we hold a commodity fund in most of our portfolios as well, which has half of its commodity exposure allocated to oil. So that's been a really decent diversifier, and it's really performed for us, as market turmoil's increased. Why has, I suppose, the precious metals struggled in Q1? Why has silver, but particularly gold, struggled? There's definitely been a bit of stabilization in the dollar. Some of the speculative position has been unwound. There's definitely been some profit taking from those areas because it did so well. Profit taking as markets have struggled in some areas. There's been some central bank selling. There's headlines of Turkey selling $8 billion worth of gold only a week or two ago. And also really some of the higher yields that are on offer elsewhere. And then that last point is worth exploring a little bit more. The graph on the right-hand side shows the performance of gold versus the yield on US tips. So US tips are really a proxy for the real return you're getting after inflation, and a proxy really for the risk-free return. Like, what can you get without really taking any risk? Gold prices tend to move inversely to US tips, which you can see on that graph on the right. The yield on the US tips is actually from 0 to 2, down at the bottom. It's inversely plotted on the graph, and that's been one of the most consistent macro trends since tips became traded in the early 2000s. If gold obviously has no yield, so if there's no return available from tips, then gold tends to do well. However, when you can get lots of positive return for very little risk on tips, gold should struggle. And I think that was obviously such strong correlation for nearly 20 years, significantly broken down in 2022. But I think there's a reasonable chance that sort of reasserts itself, and that could be a sort of bit of a headwind for gold as an asset class. Just moving on now to fixed interest. How is fixed interest done? The left-hand side graph shows performance since the turn of the year. The right is the last 5 years. They actually both tell a very similar story. So what you've got high yield outperforming investment grade, which in turn has outperformed government bonds. Credit conditions have remained, surprisingly benign. Really, what that's meant is credit spreads have tightened materially, and essentially you've been paid to take risk in fixed income. High yield also has shorter duration than government bonds typically, so that's helped as yields and inflation has risen. Well, what about 2026? The sentiment remains broadly the same, with risk outperforming in fixed interest. Credit spreads are very tight now, though, and with yields rising significantly as inflation and rate expectations have moved upwards, we think there's a great opportunity in government bonds. Just to move quickly on to inflation before reverting back to some other areas of fixed interest, just to frame what we've all read about what's going on in the Middle East, but just to frame the magnitude of some of these moves in oil, particularly the International Energy Agency only yesterday said that this conflict is creating the worst energy crisis that has ever been faced. Double WTI oil price went up from 60 to 110. It's down to 90 now, but that type of shock is much larger than the 70s and 80s and 90s. The current event has disrupted as much as 20% of the global oil supply, making it the largest supply disruption ever recorded. And critically, 85% of the oil transiting the Strait is destined for Asian markets. And that represents an immediate supply shock with no there's some long-term substitutes, but certainly no short-term substitutes. But clearly, oil is just the beginning of some of the disruptions if this continues for a while. 1/3 of global fertilizer transits the Strait, and that timing could hardly be worse. It's landing directly in front of the North American spring planting season. The full pass-through for food prices clearly is going to manifest over the coming months. Beyond fertilizer, 85% of the Middle East polythene exports transit the Strait, so you're kind of packaging, parts, consumer goods. Qatar's aluminium smelters have halted entirely. Their gas facilities were hit by an Iranian attack, taking 1/3 of global helium supply offline. And finally, jet fuel costs has doubled, and in Europe has said it's only got 6 weeks left of jet fuel. And I did read this morning that Lufthansa have cancelled. I think it might have even been 10 or 20,000 flights. So this is really happening. And at a headline level, US inflation went up to 3.26% in March, up from 2.4% in February. And core, once you strip out all those volatile areas, has also accelerated. And April is likely to be in the region of 3.7% potentially. But we do still think that if an agreement can be found, this will hopefully start to tick back down to where we were. And just delving a little bit into the UK, specifically, the graph shows a change in various different prices since 2020. And there's some things on there that are slightly less important, perhaps to some, like olive oil, but also some really important things like oil on there. So compared to the post-financial crisis era of very low inflation, there's been quite a bit of inflation really in the last 5 years, which we no doubt all have felt. Certain items, though, are actually cheaper than 5 years ago. Things like computers, mobiles, furniture, but oil and electricity up 60% over the last 5 years. Food and alcohol up 40%, up substantially. And no doubt we've all noticed food prices increasing in the shops. And the events in the Middle East are obviously providing an unfortunate tailwind to some of those dynamics, especially in the UK, where we import a hell of a lot of our energy. The other big problem with the UK is that lower income households spend a much higher proportion of their weekly budget on energy compared to upper income households. Energy is something that you have to buy. You can't really avoid not paying for energy. So people have less spare money to spend on goods and services, which is going to have a knock-on effect to the UK economy. And the IMF recently said that the UK would have the worst growth in the G7 this year. And headline inflation also at 7 a.m. this morning printed at 3.3. We do again feel like a lot of these pressures are transitory, hopefully, but I don't think we're going to go back down to the days of 0% inflation anytime soon. One reason that I say that as well is sort of longer and mid-term expectations for oil prices. So the oil forward curve is suggesting that oil really will start flowing again properly in a couple of months. Oil down to $75 to $85 by the end of this year, and 2027 to 2030 prices are around $10 higher than they were before this all started. And that's really because some countries are likely to try and build their own oil stockpiles, even after this has sort of gone away as an issue to improve their resilience to future geopolitical events. So I think this is going to mean that oil is going to be structurally slightly higher than it was, but it's not necessarily on the increase. And if oil price is a little bit higher, but is then maintained there, for the next 1, 2, 3 years, that obviously means there's no inflation in oil. It needs to go up year on year on year for it to be inflationary. And what does this mean for central banks? Well, they're in a bit of a pickle. They're in a dilemma, if you will. The Fed and the Bank of England were on an easing path, tentatively, haltingly, but an easing path nonetheless over the past few years. The market had priced in a number of cuts over 2026 to the base rate. And that pricing obviously needs to be revisited and is being by markets. Just to frame this, the Bank of England rates at 3 3/4. They were expected in February to tick down to 3 3/4 this year. Well, now actually there's 0.25% increase price into markets, although we don't necessarily think that's going to happen. In the US, the start of the year rates were expected to go down by 0.5%. Actually, they're only expected now to go down by about 10, 15 basis points, but albeit no increases in the US. And when oil has moved significantly higher in a single month, rates are just not going to be cut. And obviously, while central banks wait, the secondary effects, of course, build. But we do think that they're much more likely to be cut than increase, particularly with growth skewed in certain countries like the UK to the downside. And if the UK was to go into a bit of a poorer economic environment, certainly wage increases would moderate, and they kind of are already, which will help with that dynamic. Just trying to whiz through a bit quicker because I appreciate I'm taking up a lot of people's time. You no doubt will have read a lot over the last year or so about the level of debt in the US particularly. But another reason why the Fed are going to want to cut interest rates is their income expense on their debt. Their debt is 38 trillion. It was only 36 trillion at the start of 2025. They've added 2 trillion just in the last year and a bit. And the US now spends more servicing its debt than it spends on its military. And we all know that they spend a hell of a lot on the military. That's clear over the last 2 or 3 weeks. Why don't we see this as an immediate concern? Several reasons. I mean, the US borrows in its own country, so obviously that actual default risk is removed. The US is focused on growing its economy. If it grows quicker than the increase in the interest cost on its debt, that is therefore problematic. It's continued demand for treasuries from central banks. Other countries like Japan have been living with far higher, huge debt burdens for a number of years. There's a lot of the share of treasuries are held by the US government, US households, pension funds, etc. So it's less prone to capital flight. And there isn't really any credible alternative to the US dollar for global trade, although we might come on to that later on if we have time. And also, high debt levels and increase in debt is not just a US issue. You can see there on the left-hand side, the UK has actually increased its share of debt more than any other G7 country in the last 5 years. So it's not just a US-centric thing. And back onto bonds. I mean, my background is fixed income, so I'm very excited about the returns that we might expect from bonds over the coming few years. Really good opportunity, especially in government bonds. I think from a low risk, what is a low risk asset now. There's obviously a very high correlation between the yield that you buy fixed income at, particularly government bonds, and then a subsequent 3-year return, which you can see on that left-hand side graph. There's a very high correlation. And if we think that the rise in yields and inflation is temporary, which we do, the yields might come down as we move through the year. 10-year gilt yields 4.75% at the moment. 10-year Treasury yields 4.25%, so pretty attractive on an absolute nominal basis. To us, though, we think the risk reward is pretty asymmetric in this case in an investor's favour. And on the right hand side, just to flesh this out a little bit more, if you purchase a 10-year gilt at the moment, for 4.8ish, for 4.75, you would need yields over the next year, over the next 12 months, to rise to close to 6% from here before you actually lost money in the next 12 months with the coupons included. I think that's a reasonable stretch to think that is going to happen. It could, of course. In the same breath, if yields move down to 4%, your total return is actually nearly 13%. So that's a very exciting opportunity if you do think that rates might actually have to come down, particularly in the UK where the economy is very weak. There's also opportunities outside traditional government bonds and also outside traditional high yield corporate bonds. We hold an asset-backed security fund in portfolios at the moment, which invests in things like residential mortgages, commercial mortgages, auto loans, and small business loans. It yields actually more than high yield credit. It's also very high credit quality, though, so it's better yield than high yield, but yet nowhere near taking the same level of risk. And it's substantially outperformed high yield bonds, even though that's an area which I said earlier on in the presentation has done very, very well. Why do we like that? Very briefly, well, actually, a lot of the underlying investments that it has a floating rate, so as somewhat inflation protected as inflation goes up, they just get more return on that. There's obviously an element that a lot of these are asset backed. There's physical assets that back some of these loans that they give out. And also, asset-backed securities have far lower default rates than traditional high-yield corporate bonds, which you can see on the right-hand side, maxing out at only a couple of percent. So just to finish off the market update, I'm nearly bang on half an hour, which is perfect. Just to frame everything that I've gone through, our asset allocation is neutral. We see equally attractive opportunities in equities and fixed income. We don't have a significant regional tilt either at the moment versus world equities. However, versus some of our peers, it's probably fair to say that we have a little bit less in the home markets and more in the US. We remain positive on quality sectors like healthcare, staples, and utilities, which I touched upon earlier. The interest rate duration that we're taking in our fixed income exposure is slightly shorter than peers and benchmarks. We think that returns on shorter dated are very attractive and similarly attractive to long dated bonds. Why really bother take that extra risk? And as I said, we're happy to take credit risk in fixed income, but we're selective given spreads have narrowed very substantially. And finally, alternatives certainly are adding value, particularly if you're in one that is exposed to the commodity cycle. And then just to summarize as well, we've done the market update. Just very briefly, we've just, as a business, launched a new service on the Novia platform. So many of you, if you're advisors, would be familiar with our international MPS service on platforms, but we've recently launched the MPS Lite solution. So what is it really? It's a way to access Canaccord's centralized investment process for a lower cost, while substantially reducing the amount of transactions that go across client portfolios. These models are only available on the Novia platform at the moment. They're available in sterling, dollars, and euro, and in the three middle risk profiles: low to medium, and medium to high. They've got a streamlined number of holdings, which I'll show us in the next couple of slides, compared to our traditional MPS service. And the models are reducing the complexity. So what we're going to do is we're going to combine 9 ETFs with 2 of our internal Canaccord funds, a bond fund and a growth fund. The growth fund essentially is a fund that mirrors our MPS medium to high strategy. So you've got all the underlying holdings within that's in our MPS. And the bond fund invests in all of the fixed income securities that our MPS strategy holds. So through this combination, an investor is still going to receive the same asset allocation, geographic exposures, thematic exposures as traditional MPS clients, but just in a little bit of a simpler way. And actually, just probably the most important thing, we don't take any annual management charge on this service. The charges are essentially taken through the underlying 2 Canaccord funds. So what would be the benefits of this light solution to clients? It's simplified, purposefully for platform investment and management. It allows access to our full discretionary models, if you will, for a much lower lump sum, reducing the number of transactions and corresponding platform trading charges, which we know is important. And it's sort of minimizing that portfolio turnover without generating trades. There's very swift replication of our centralized investment office changes in portfolios, because that's going to immediately feed through to the 2 Canaccord funds within the strategy, with the ETFs being held relatively static and unchanged for the long term. It also allows access to much cheaper share classes than would be available on the platforms, because our 2 funds are investing in very, very, very cheap share classes which you couldn't access on platforms. So you're getting some exposure to that as well. And obviously it's a simple and transparent holding structure, charging structure. It makes it easy to understand the underlying exposures and what someone's getting. And fact sheets are available, investment proposals are available. And for the right size client, the resources of an investment manager like myself joining a call to help get an account over the line or to help defend an account, we're there to help. Just very briefly now, just to summarize, that's just the asset allocation as you go through the three strategies. You can see the variety of exposures we have in terms of regionally and asset class. This is just the sterling ones. As you might expect, the equities clearly are going to be graduated higher as we go through the low to medium to high. But it's very, very aligned to our normal MPS, our other solutions, which people will be very, very familiar with. We're not trying to reinvent the wheel. We're just trying to make it slightly easier for a specific type of client to access. And then just to frame as well some of the underlying holdings, you can see there at the top the Canaccord Bond Fund, and number 9, the Canaccord Growth Fund, depending on the risk profile. A reasonably large proportion of the models are obviously invested in those two assets, and then the rest of the portfolio is invested in very low cost ETFs, which, as I said, will be held relatively static. There's not going to be too much turnover, and I think we achieve a really decent return for investors, and that's going to benefit as well from Canaccord's massive focus on risk-adjusted returns, hopefully reducing those pullbacks in markets. We normally do not pull back as hard, and that's shown in the last 2 or 3 weeks to obviously be really, really important. And then just to finish off in terms of the underlying holding charges, I think with very, very cost effective. That's all the charges that a client is going to receive from us, because the charges are taken essentially from the underlying funds and ETFs. So that is what it is, 70 to 80 basis points, which I think is competitive. And with that, I'm going to stop sharing and end the presentation.
Thank you very much, Scott. Very timely and in-depth analysis there. So thank you very much for that. We do have some questions posed from the audience today, so I'll jump straight into those with you. And the first one is asking for your thoughts on a large US exposure and the dollar as well.
Yeah, well, I think I've talked through some of the reasons why we like the US equity market itself around really decent earnings, productivity growth, exposures that you can't get elsewhere. I think the dollar for a period of time had rallied really strongly, sort of from 2020-ish, and it probably was looking a bit expensive in April with the Trump tariff announcement. We had that big reset of like 10-12% versus the euro, slightly less versus sterling, which I think has been probably the reset it needed. And largely it's kind of traded sideways, although it's been slightly stronger as the Middle East conflict unfolded. I think some of that recent economic data being positive is obviously going to underpin the dollar. Rates aren't going to come down as quick as probably Donald Trump would like in the US. The slightly higher for longer or to reduce slightly slower is normally good for the currency. There has been, as I said, a slight uptick in the dollar in terms of safe haven demand around the geopolitical risk. And also recently, Fed independent signals, are suggesting a bit more positively, like, they are going to remain independent, basically. There was some comments from Fed chair nominee Kevin Walsh yesterday as well, which were taken pretty positively. The negatives for the dollar wouldn't be a surprise to anyone. Probably the rising concerns over de-dollarization. But I think that these things are very slow burners. These are the big things that have happened for 10, 20, 30 longer years. And ultimately, most trade globally is still in dollars. It's very hard to change that. So I still think, even with the fiscal trajectory deficit concerns in the US, I still think that the story is ever slightly more on the positive side than the negative side for the dollar. Although one would hope that it doesn't really move hugely, and we're quite happy for it to go sideways, because really we're buying those areas for the market, not necessarily the currency. Within our portfolios, all of the non-base currency exposure in fixed income is always hedged, because we don't want a 5% currency move wiping out all the return from the yield on fixed income. But in equities, we are quite happy to take the currency risk because we think that sort of should, over the long term, kind of balance itself out.
Great stuff. Another question here. As you'd expect, Trump always pops up at these events. What are your thoughts on TACO? Do you think we're seeing it again with just another extended ceasefire at the moment?
I mean, in summary, yes. I mean, it's hard to argue that we haven't seen that, because it feels like, Trump says something extreme, Iran says something equally extreme. They're trying to, push it as far as possible, and it seems to be at almost every opportunity. Eventually, it seems to be Trump that is the one that's sort of folding, and so I think that is absolutely the case. Look, the war is incredibly unpopular in the US, so he needs some resolution. He's clearly conscious, of upcoming, some political changes, some of the, regional elections in the US. He's massively focused on the S&P 500, right? He doesn't want to see markets go down because his chums and a lot of people in America lose a lot of money. So there's a lot of people incentivizing him to come to some sort of deal, and also clearly that is the right thing to do morally, for the world, right? We want to see some semblance of deal. Markets are absolutely telling us that they are going to come to some sort of deal, and if there isn't one, markets are going to move quite aggressively potentially. But we don't have a crystal ball like anyone else, but we do think that it's more likely that hopefully risk will start to reduce, and we just need to keep a real close eye on some of those second order effects from oil rising. Yeah. So it's going to be a slow burner before we get back to where we were. But earnings continue to be really strong, so it makes sense why markets are sort of shrugging this off, I think.
Great. So, and then the last question from the floor. Thanks for today, Scott. Could you share a bit more information regarding the infrastructure element of your portfolios? For example, are there any specific companies that you think are the driving force behind growth?
Yeah, I mean, we would access that area very broad based. Historically we used to have specific targeted exposures, like we had like a solar energy or a wind energy exposure, some investment trust historically, and what we found was it was too sort of cyclical. Some of those areas too specific. It wasn't broad enough. And whilst it would be in vogue for a year or two, it would then have periods where it would struggle for quite a while. So we would rather access infrastructure much more broad-based, be it renewables, data centers, the power behind data centers, and because ultimately some of the tailwinds around government spending and infrastructure, it's not necessarily targeted in one specific area. Of course, it's going to target broad base, because by targeting a broad base, that's getting more people involved, more people working, more economic growth from a broader area. So I think just having some broad-based exposure is better than being specifically targeted at the moment. Although clearly there's some exciting things going on, around the data centers. But we're obviously conscious that being in maybe a spicier area has potential for higher growth means there's clearly higher risk that comes with that. We're really focused on reducing risk and getting decent risk-adjusted returns. So broad base for us is a better way to approach it.
Great stuff. That's it for the questions. I know you're heading off straight from here to go on holiday, so you can loosen the tie and relax now.
Yeah,
so
I know.
Thank you very much for that. I'd just say to everybody who's online today and those who've registered, maybe watching later on, copies are available from today's session. And we mentioned the light MPS service that's now available on the platform. If you need any further details on that, of course, you can get them from your usual Novia Global Sales contact. We will be doing another webinar later in May, so keep an eye out in your inbox. A little bit different on the next one. It'll be more process focused on our platform, and we'll be doing a surgery type webinar in terms of the functionality that is available for you. So that's an interesting one to look out for. So it just leaves me to say thanks again, Scott, for your input today, and look forward to seeing you all again in the near future. Many thanks. Goodbye.
Thanks very much. Cheers.